Preparing for a FP&A Analyst at Duke Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a utility company like Duke Energy? FP&A helps Duke Energy connect operational decisions with financial outcomes. I would support budgets, forecasts, variance analysis, capital planning, and management reporting while considering customer demand, fuel costs, weather, regulatory recovery, and reliability requirements. The role is not simply reporting historical results. It explains what changed, why it matters, and what management should do next. Strong FP&A also creates a common financial view across generation, transmission, distribution, and corporate functions. While answering, focus on planning, forecasting, performance analysis, decision support, regulated utility economics, capital allocation, operational reliability, and translating financial results into actions for business leaders. Question 2. Why do you want to work in FP&A at Duke Energy? I am attracted to Duke Energy because FP&A combines rigorous analysis with decisions that affect essential infrastructure and millions of customers. The company is managing reliability, affordability, capital investment, and the transition toward cleaner generation, which creates meaningful planning complexity. I would bring strong Excel skills, attention to detail, and a willingness to learn the business deeply. I also value roles where financial analysis influences operating priorities rather than remaining separate from them. Make sure to cover Duke Energy's scale, essential service mission, energy transition, regulated environment, analytical development, and how your skills in forecasting, modeling, communication, and business partnership support the company. Question 3. How would you build an annual budget for a utility business? I would begin with the latest actual results and establish a driver-based baseline. Key assumptions would include customer growth, weather-normalized demand, fuel prices, generation mix, labor rates, maintenance schedules, storm expectations, depreciation, interest, and planned capital projects. I would gather input from operating leaders, challenge unsupported assumptions, document changes, and reconcile the plan to accounting and regulatory requirements. Finally, I would consolidate the submissions, perform sensitivity analysis, and communicate the approved budget clearly. In your answer, talk about business drivers, baseline results, operating assumptions, demand, fuel, labor, maintenance, capital spending, regulatory items, stakeholder review, consolidation, and approval controls. Question 4. How do you forecast revenue for an electric utility? I would forecast revenue using customers, usage per customer, approved rates, and expected load by customer class. I would separate volume, price, weather, and mix effects so the forecast is explainable. For Duke Energy, I would also consider rate case timing, fuel or purchased power mechanisms, industrial demand, distributed generation, and seasonal patterns. I would compare the model with historical relationships and operational forecasts, then update assumptions when actual usage or regulatory decisions change. Be sure to mention customer count, usage, weather normalization, rate cases, tariffs, load mix, seasonality, economic conditions, renewable generation, and reconciliation between operational drivers and reported revenue. Question 5. What are the most important cost drivers for an electric utility? Major cost drivers include fuel and purchased power, employee compensation, maintenance, storm restoration, transmission expenses, depreciation, interest, environmental compliance, and technology investments. I would distinguish controllable costs, such as staffing or discretionary maintenance, from market or weather-driven costs, such as fuel prices and storm impacts. That classification improves accountability and forecasting. I would also understand which costs may be recoverable through regulatory mechanisms, because accounting treatment and customer rate recovery can differ. Focus on fuel, purchased power, labor, maintenance, storm restoration, depreciation, interest, environmental compliance, transmission costs, and the distinction between controllable and externally driven expenses. Question 6. Walk me through how you would analyze a budget to actual variance. I would first validate the data, confirm the budget version, and identify material variances by business unit and account. Then I would decompose the difference into volume, price, timing, mix, one-time events, and execution effects. For example, an unfavorable generation expense variance could reflect higher fuel prices rather than poor cost control. I would speak with the responsible operator, assess whether the issue affects the full-year forecast, document the root cause, and recommend an action. Make sure to cover data validation, materiality, price-volume mix analysis, timing, one-time items, operational drivers, accountability, root cause, forecast impact, and concise communication of recommended actions. Question 7. How would weather affect Duke Energy's financial forecast? Weather affects both demand and expenses. Hotter summers can increase cooling load and revenue, while mild conditions may reduce usage. Severe storms can create restoration costs, outages, and timing differences. I would compare actual heating and cooling degree days with normal conditions, quantify the financial sensitivity by customer class, and distinguish weather-driven effects from underlying demand trends. For planning, I would use normalized assumptions and scenarios rather than treating one unusual season as a permanent trend. Discuss heating and cooling degree days, load sensitivity, seasonal revenue, storm costs, weather normalization, regional differences, scenario analysis, and separating temporary impacts from recurring business trends. Question 8. What is rate base, and why is it important in utility FP&A? Rate base is the regulated investment in assets used to provide utility service, generally including eligible plant and working capital, less applicable deductions. Regulators typically allow recovery of prudent costs plus an approved return, subject to the jurisdiction's rules. It matters in FP&A because capital deployment, depreciation, financing needs, and revenue expectations are connected to rate base growth. I would never assume every project creates value. Timing, approval, execution, affordability, and allowed returns all matter. In your answer, explain rate base, prudent utility investment, allowed return, depreciation, regulatory recovery, capital planning, and why rate base growth does not automatically equal shareholder value creation. Question 9. How would you evaluate a major capital project at Duke Energy? I would evaluate the project's reliability or strategic need, scope, schedule, total installed cost, operating benefits, funding requirements, and regulatory pathway. Financial analysis might include NPV, cash flow timing, depreciation, financing costs, and potential rate recovery, but I would also test construction delays, cost overruns, demand changes, and policy assumptions. After approval, FP&A should compare actual spending and milestones with the authorization, explain variances early, and update expected returns and cash needs. Be sure to mention strategic need, reliability, regulatory approval, construction schedule, total cost, NPV, funding, contingency, rate recovery, risks, sensitivity analysis, and post-investment performance monitoring. Question 10. How do you distinguish a forecast issue from a budget variance? A budget variance explains why actual results differ from the approved plan for a period. A forecast issue asks whether those results change the expected full-year or forward outlook. For example, a delayed maintenance project may create a favorable current month variance but an unfavorable later period forecast if the work remains required. I would analyze the remaining run rate, update timing and assumptions, and communicate both the historical explanation and the forward-looking implication. Focus on the difference between historical performance versus plan and the expected future outcome, including timing, revised assumptions, run rate analysis, forecast updates, and clear management communication. Question 11. What financial statements and metrics would you monitor in utility FP&A? I would monitor the income statement for revenue, operating expense, depreciation, interest, and earnings, the balance sheet for capital assets, working capital, debt, and liquidity, and cash flow for operating cash generation, capital spending, and financing needs. Utility-specific metrics would include rate base growth, customer additions, load, fuel expense, reliability indicators, and capital project execution. I would connect the statements, because higher capital spending affects cash flow, debt, depreciation, and future earnings. Mention income statement, balance sheet, cash flow, EBITDA, operating expense, capital spending, free cash flow, debt, liquidity, rate base, reliability, customer growth, and links among the statements. Question 12. How would you analyze cash flow and liquidity for Duke Energy? I would start with operating cash flow, then forecast capital expenditures, interest, taxes, working capital movements, dividends, and debt maturities. I would pay particular attention to large construction programs and uncertain storm or fuel-related cash needs. A monthly liquidity view would identify peak funding requirements, available revolver capacity, and refinancing dates. I would run downside scenarios and coordinate with Treasury, accounting, and operating teams so the forecast reflects both contractual obligations and realistic execution timing. In your answer, cover operating cash flow, capital expenditures, debt maturities, interest, working capital, storm spending, financing plans, liquidity buffers, scenarios, and coordination with Treasury and accounting. Question 13. How do regulatory decisions affect financial planning? Regulatory decisions can change revenue, allowed returns, recovery timing, capital plans, and cash flows. I would track rate case milestones, approved versus requested costs, jurisdictional treatment, regulatory assets or liabilities, and any conditions attached to recovery. Because outcomes are uncertain, I would model base, upside, and downside cases rather than embed unapproved benefits. I would coordinate with regulatory, legal, accounting, and operations teams, then clearly label assumptions and update the forecast as decisions mature. Make sure to discuss rate cases, authorized returns, prudence, cost recovery, regulatory assets and liabilities, timing, jurisdictional differences, scenario modeling, and close coordination with regulatory and accounting teams. Question 14. Tell me about a time you found an error in a financial model or report. In one project, I noticed that a forecast margin moved sharply despite stable operating assumptions. I traced the issue to a duplicated expense category created during a data refresh. I reconciled the model to the general ledger, quantified the impact, informed my manager promptly, and corrected the formula and source mapping. I then added a control check comparing key totals with prior versions. The experience reinforced that analytical review is as important as building the model. Focus on how you detected the issue, validated the source, assessed materiality, corrected it, communicated transparently, strengthened controls, and balanced urgency with avoiding unsupported conclusions. Question 15. Which Excel tools would you use for FP&A analysis? I would use structured tables, SUMIFs, XLOOKUP, pivot tables, charts, and scenario switches for recurring FP&A work. Power Query can improve repeatable data preparation, while data validation and reconciliation checks reduce input errors. For larger models, I separate assumptions, calculations, outputs, and supporting data, and use clear labels and consistent signs. I also test formulas with known results before distributing a report. The goal is a model that is accurate, transparent, and easy for another analyst to update. Be sure to mention structured formulas, pivot tables, XLOOKUP or index match, SUMIFs, scenario analysis, charts, Power Query, data validation, error checks, and model documentation. Question 16. How would you explain a complex variance to a non-financial operations leader? I would lead with the business conclusion, not accounting terminology. For example, I might say, costs are $2 million above plan, primarily because fuel prices were higher, while maintenance spending was $400,000 below plan. I would separate controllable from external drivers, use a simple bridge or chart, and explain whether the variance changes the full year outlook. I would then ask for the operator's perspective and agree on an action, owner, and follow-up date. Discuss leading with the business message, using plain language, quantifying drivers, distinguishing controllable factors, avoiding jargon, confirming understanding, and connecting analysis to a practical decision. Question 17. How would you handle conflicting assumptions from different business partners? I would first clarify what each team is forecasting and which operational driver creates the difference. I would compare assumptions with historical data, current trends, contracts, and known business events rather than choosing the more optimistic view. If uncertainty remains, I would present a base case and sensitivities, document the rationale, and escalate the decision with facts. Once leadership selects an assumption, I would ensure the same version flows through every schedule and report. In your answer, cover understanding each perspective, defining the driver, using historical evidence, documenting assumptions, scenario analysis, escalation, alignment, and maintaining one controlled version of the forecast. Question 18. What controls are important in the FP&A reporting process? Important controls include controlled source data, restricted access, version naming, documented assumptions, reconciliations to the general ledger, review sign-offs, and checks for unexpected movements. I would maintain an audit trail for manual adjustments and require approval for material changes. Segregating preparation from review reduces risk, while threshold-based variance commentary keeps attention on significant items. Good controls should protect accuracy without making the process so cumbersome that teams bypass it. Focus on data integrity, access controls, version management, reconciliations, review evidence, variance thresholds, approval workflows, audit trails, segregation of duties, and protection of confidential information. Question 19. How would you prioritize competing deadlines during the monthly forecast cycle? I would map each deliverable by deadline, decision impact, dependencies, and effort. A regulatory or executive submission would take priority over a lower impact analysis, but I would confirm expectations rather than assume. I use a task tracker, establish data cutoffs, communicate risks early, and reserve time for validation. If deadlines conflict, I would propose a practical sequence and escalate trade-offs with options. Speed matters, but I would not sacrifice reconciliation or explainability. Mention materiality, decision deadlines, dependencies, data availability, stakeholder communication, organized task tracking, quality checks, escalation, and distinguishing urgent work from work that can be sequenced later. Question 20. What would you do in your first 90 days as a Duke Energy FP&A analyst? During my first month, I would learn Duke Energy's businesses, regulatory structure, reporting calendar, systems, chart of accounts, and key performance drivers. In the second month, I would shadow the forecast and close processes, review prior variance explanations, and meet operating partners. By the third month, I would own defined analyses, improve documentation or recurring report, and validate my work with stakeholders. My priority would be credibility through accurate, timely outputs before pursuing larger process changes. Be sure to mention learning the business and regulatory context, understanding systems and reporting calendars, building relationships, reviewing prior forecasts, identifying process improvements, and delivering reliable early wins. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.